All right, hello everyone, and welcome to our latest webinar about the Employee Retention Credit. My name is Chris Wittich, and I'm the head of the ERC team here at Boyum and Barenscheer. I'm a partner in the BAS department, the Business Advisory Services department, when I'm not doing ERC. But if we're being honest, I do ERC almost all day, every day now. And as the title slide would suggest, one of the takeaways from today is that we've got a new email set up to help us organize, because it is a team. It's not just me. So we would like people to use erc@myboyum.com when you have questions or you'd like to start looking at a project. So without further ado, we have a very ambitious agenda today. And I hope we can get through all of this. And I hope that it can be, that you think it's organized in a way that makes sense. The disclaimer, of course, is that, ERC has changed a lot of times. It's possible it can change again, but this is based on the most current information that we have. So the agenda today, just a quick thought on PPP loans before we move to the meat of the webinar, which is going to be the ERC. We'll go over the basic overview. We're going to go over some very detailed examples and then talk a little bit about our internal procedures, how we price it. We'll talk about misconceptions that are very common as we've talked to people. And then if we have time at the end, we'll just hit a little bit on the cash planning, because this is very unusual. And a lot of times, the last 2 years have been very strange. There have been PPP loans. Now we got ERC, EIDL loans. We got all this money flying around. So what do you want to do with your cash? How do you want to plan for that cash in your business? And we will do Q&A at the end. So if you have questions, put it in the chat. We've got Nick and Tiffany, who are the other two main members of the ERC team. If it's a simple question, they might just chat you back with the answer. Otherwise, we'll take those questions at the end and maybe they'll jump on and help me address any questions. So the only slide here on PPP loans, we've done so many webinars about PPP loans. Certainly the first forgiveness is probably long in the rearview mirror. For many people, I would say PPP2 forgiveness is already wrapped up as well. You want to be doing that now. The deadline is probably coming up, like April, May, June is perhaps your deadline. So you may still have time. If you have not done PPP2 forgiveness quite yet, that's fine. But we want to be clear about the last 3 points here. Please use 24-week covered period. Please use the full 24 weeks worth of payroll costs. And please use 24 weeks of non-payroll costs up to, there's a 40% cap. If you have any questions about that, we'd love to help you, and just make sure that you're using 24 weeks. It really makes a huge difference if you are qualifying for ERC. And so now let's start talking about ERC, and we'll see why that will matter, the covered period that you choose to use on your PPP forgiveness. So we'll talk briefly about the 20 rules and then the 21 rules. They're similar, but a little bit different. So you can claim ERC in 2020 and 2021. It's obviously retroactive. Those years are over. But you can go backwards and claim this employee retention credit. The qualifications in 2020, you're looking at a gross receipts decline of 50%. You look at quarter by quarter, and there's a $10,000 cap per employee for the full year in 2020. The credit amount is 50%. So 50% of 10 grand, that means the maximum per employee is $5,000. You can also include healthcare costs, but you cannot be double dipping between the PPP wages and the ERC. And this is where it begins to become complicated. But that's just the beginning of the complications. So there's three ways that you qualify for ERC. There's a gross receipts test. It's very black and white. Either you meet it or you do not. There's no wiggle room. There's no real ambiguity about it. You meet it or you don't. There's a totally shut down. It's pretty obvious if your business was totally shut down in 2020. Think of, restaurants, salons, non-essential businesses. The government said, you are closed, period. So that's also very clear. Usually that's not super useful because a lot of people just did not pay people when they were closed, but that is a way to qualify. The third way is where we spend most of our time, and that's the gray area. That's a partial shutdown. So the government created an order and it limited your ability to do business. We have a couple examples here. We will get more into this later on in the examples, but like a space restriction. So you're limited to the number of people that can be in your business. You used to have 100 people at once. Now you can have 50 or 25. That's a partial restriction where you're not totally shut down. You're allowed to be open, but you're dealing with these restrictions. If there are certain types of service offerings that you're not allowed to do, but you are allowed to do other ones, that would be another good example of a partial restriction. On the gross receipts test, I said it was black and white, and it is. And still, we have a chart that looks like this to figure out whether or not you qualify for ERC based on the gross receipts test. So even the most simple thing, the gross receipts test, is complicated enough that we have a sheet that looks like this to help people figure it out for 2020. So, even the simplest part is complicated as it relates to ERC. We're going to skip this example, but it'll be in the slides if you'd like to read it later. Again, these examples, we'll get to some better ones. I want to make sure we have time for those. So for 2021, they changed the rules, but they extended ERC, so ERC does exist in 2021. You can sort of have both the PPP2 or PPP second draw, and you can do ERC in the same year. They changed the qualifications. So a qualifying business now, you're looking at a gross receipts test is down 20% instead of 50%. So that's a little bit easier to qualify. Or, typically there's not too many total shutdowns in 2021. There could be a few, but not very many. So then it's the partial shutdown that also applies in 2021. They changed the way the calculations work. So the credit is now up to 10,000 of wages per employee per quarter instead of per year. So that's better. If you qualified for the first 2 quarters, now you can get 10 grand first quarter, 10 grand second quarter. They also changed the credit amount. It's 70% instead of 50%. So the amount that you're getting based on the same wages is higher. They also changed the size rules. In 2020, it was based on this FTE count of 100. Now it's based on an FTE count of 500. So that makes a big difference for, slightly larger, but still medium-sized businesses. So a lot of changes in the way the calculations work. And, I would say you don't need to worry so much about that because the main ways that you qualify for ERC, they are the same. We got gross receipts, we got total shutdown, and we got partial shutdown. So that's the key thing to understand. The calculations are very complicated. They're slightly different, but complicated in 2020 and 2021. That I would sort of leave that to us, but just know that in 2021, the credit is a little bit better based on the way the calculations work. Again, you cannot be double dipping on the PPP forgiveness and the ERC. And then these last 2 points, this is where they made it more complicated. They had said you can claim ERC for all 4 quarters. Then in the middle of 4th quarter, they changed their mind and said, no, you can't do 4th quarter anymore. So the normal ERC exists for the first 3 quarters only in 2021. And then we have a new definition, which we're not going to spend much time on today, but it is a recovery startup business. That's another way to qualify for ERC. The calculations are different again, but exists only in the 3rd and 4th quarters of 2021. And in order to get that, you need to be a startup business, or you need to have a startup business. So there are rules about the size, and there are rules about when you started. Generally speaking, the way to remember this is if you started too late to qualify for a PPP loan, then you can or probably do qualify for this recovery startup business ERC, as long as you meet the other tests about the size and some of the grouping. So we're not going to focus on that, but if you have a new business that started sometime in 2020 or in 2021, there is this sort of separate carve out for ERC, so you can potentially get that. So I would definitely look into that if you do have a new business that just started. So for 2021, again, we have a chart to handle the easy part, which is the gross receipts test. If you notice, this chart is different than the chart in 2020. So, similarly kind of black and white. It's just that the rules themselves are different. But that's why we have a new chart. So we'll go through just sort of one generic example before we really dive into the good examples. So if we have a non-essential business, maybe like a restaurant, something like that, or a salon, they're experiencing restrictions. They've got basically 6 weeks from January 1st to February 15th. They got 6 weeks of restrictions. Maybe they're at 50% capacity, 75% capacity, whatever. The business for that first quarter, 2021, they have 75% of the gross receipts as compared to 2019. And then they have 90% gross receipts in the second quarter because things are better. There's no restrictions. So based on the partial restrictions, they qualify for this 6-week period, January 1st through February 15th, based on the partially restricted business operations. But we don't stop there. We keep going and we look at all of the tests. So based on being at 75% of the gross receipts, they end up qualifying for the entire first quarter gross receipts test. So that's great. We went from half a quarter to now we got a full quarter based on gross receipts. And if you go back to this ridiculous looking chart, you can basically follow along that because first quarter qualified based on gross receipts, they also get all of the second quarter. So we started out with like 6 weeks worth of restrictions, which dropped our gross receipts a bit. And we ended up with 6 months worth of qualifying period for ERC. So you want to look at all of the rules. You don't want to just focus on the restrictions. You don't want to just look at the gross receipts. You want to look at all of them, and then you get to choose the one that qualifies the business for the longest period of time. This is very helpful. So we've talked about, some of these tests. Each one has nuances to them. So we're going to try and talk about some of these nuances as best I can. It can be a little bit jumbled. This is the most complicated thing I've ever done in 15 years of practice. It's in many ways the most rewarding thing I've ever done, but it's definitely the most complicated. And we are not gonna, we could have a half an hour on each of these bullet points. And there are a bunch of bullet points that I didn't put on these slides, but we're gonna try and hit some of the highlights. So when we're talking about gross receipts, first we need to even understand what that is. That's on a tax basis, the gross receipts of the business. The sale of assets is included. The gross sale proceeds are included in that gross receipts number. So if you, sold a piece of equipment, but you claimed a loss on that piece of equipment, it's the gross sales price that counts as gross receipts, not the net income on the sale of that asset. And so this, can be helpful in certain situations. Certainly when you're looking back and trying to measure gross receipts in 2019, then 2020, then 2021 on a quarterly basis, that can be an outlier. When you have the sale of assets, that can be a very big number sometimes. If it happened in 2019, that'll be good. If it happened in 2021, that'll be bad. But you need to include it in your sort of analysis of gross receipts. Grouping is going to create extreme results as it relates to gross receipts. And we will get into what that grouping looks like. A purchase of a new location. If you're a franchise owner and you purchase a new location, there is the ability to sort of look back prior to when you purchased that location and look at those gross receipts. If you close a location or you close one line of business, that is a key element to the gross receipts test. You can look at changing your accounting method. As I said at the start, this is the tax basis gross receipts. So if you change what your tax basis is, you can change what your gross receipts are for tax purposes. The prior quarter election, which we touched on in the last example, is a very good example of it's sort of complicated how it works, but it's a key thing to understand is in terms of gross receipts, especially when you're looking at fourth quarter of 2020 that comes into the first quarter of 2021 with that prior quarter election. So gross receipts is the easiest thing. And even within the gross receipts, it is very complicated. And there are nuances which can make a world of difference. So perhaps the more complicated thing is even these partial restrictions. So I'm open, but I'm dealing with restrictions. So what do we mean by that? What are some examples? Anything that is non-essential. So non-essential, there were, dental appointments, eye appointments canceled by the government, basically, where they said, no, you can do the really important stuff, you can do the emergency stuff, but you can't do the routine appointments right now. So when that aspect of a business is restricted or limited, then it qualified them for ERC. And so we've done studies that have this exact sort of fact pattern. If you think about, one example would be like a home healthcare business. We had one where they lost an incredible amount of days to people quarantining. So that's employees and or clients. The government says you're supposed to quarantine for 14 days, then it was 10 days. It's been all over the place. But when you're losing all of that workforce, those labor hours, it amounted to a partial restriction of the business because it was quite substantial. This isn't 1 out of 200 people. that had COVID for a week. It was more substantial than that, but it ended up qualifying them for ERC. We think about capacity restrictions. I think this is sort of the easiest one because we all understand what the restaurants went through, or other hospitality businesses, salons. They're the classic example of sort of non-essential, and we have done a ton of ERC for hospitality, restaurants, and salons. When a restaurant is open at 50% or 75% indoor dining, that is a restriction on their ability to do business, and it's because of the government order. It really doesn't matter how much takeout they do, how much delivery they do. A portion of their business, a big portion of their business, is indoor dining, and now they can't do as much indoor dining as they want to or used to, and so that is a restriction. You think of a hair salon, if they have 10 stations, and then the government says, well, all these stations need to be 6 feet from each other, or you need to be at 50% capacity. Well, they just went from 10 stations to 5 or 6. That is a classic example of these partial restrictions. Hospitality businesses, where they're limiting the number of people, like in an event space, where you can't have an event of more than 50 people. Well, you're running you've got an event space business, and you typically throw, weddings with 200-300 people, and now you're limited to 50. That's a pretty big, substantial impact on the business. That is a good example of partial restrictions. So some other ones we've done, a manufacturing production team that was unable to work together. It slowed down the production, it slowed down the output, even though the manufacturing facility itself was open. So they were open, and maybe not every manufacturer is going to qualify, but some do, because of the restrictions that were on them, even though they were open. So it's a little harder to see this than the restaurant that's at 50% indoor capacity, but it can still occur in situations like this with manufacturing production. Social distancing at like a mental health clinic type of setting. It ended up reducing by quite a bit the revenue per clinic hour. It reduced the revenue per professional because they were spacing out the sessions. They couldn't do group sessions. It had an impact on their ability to see as many customers, to serve as many customers as they did before. So it's a little less obvious than the salon, where they're like every other station's empty. But these are some of the other good examples that we've seen where business has qualified based on partial restrictions. So I teased this a little bit earlier, but the grouping rules are crazy complex. And I've highlighted in red, if grouping applies, grouping creates extreme results. It is either extremely good or extremely bad. Occasionally, it doesn't make any difference, but otherwise it is really, really good, or it is really, really bad for your ERC outcome. And the grouping rules are not optional. This is a key point. If something bad comes of grouping, there's no like, oh, we'll just elect out of it. We'll just blow it off. Like, these are part of the rules. So the grouping rules, we could definitely talk about these for like 5 hours, but we've got situations where there are affiliated service groups. They're sharing management. they're sharing services. You might have a management company that's providing services to, maybe rental entities or other professional service types of activities. If there's a management company, you really want to look closely at these and see what is that company managing. If they're managing, another entity or activity with some shared ownership, that's a situation where you really want to dive into these grouping rules. The controlled group rules for tax purposes are what these are based on, so those apply. A couple examples are going to be, groups of 5 or fewer people that own 80% or more of the stock. You've got family attribution in there. You've got common control is a key idea. If you've got shared 401k plans, that's a good example. Between like brother-sister types of companies, that's a pretty good indication you've got this grouping or aggregation for the purposes of ERC. So again, the grouping creates very, very extreme results. And we'll talk about sort of why that would be. It means you add together everything. If you're adding together the employees, that is looking at the FTE thresholds. That's bad. Because now your group is bigger and you might get to be too big to qualify for ERC. So only bad things happen when you add up FTE counts. You're also going to add together the gross receipts for all of these things. And that could be either good or bad. Either the gross receipts are so good for one entity that it sort of disqualifies the other one that was struggling, or the gross receipts are so bad in one that it qualifies the other one that was doing okay. So you can have either good or bad outcomes, but it's going to be extreme. You can add together the partial restrictions, which is going to be a good thing. That means if one member of the group is restricted, then the whole group is restricted. So this is always a good thing. If you factor in the startup business rules, this grouping will combine the gross receipts. So having a group with the startup rules is both a good and a bad thing. You're sort of sharing the fact that it's a startup, but you're also sharing all of the gross receipts. So it's both a good and a bad thing. So we got situations all over the place, but you need to consider these grouping rules sort of before you really tackle the ERC. I've thrown in a few other examples of these are other rules which can make a huge difference and you really need to understand them. But the FTE rules are measured in 2019. They're not measured in 2020 or 2021 when you're claiming the credit. They're measured in 2019. And how they are measured, I assure you, it is not how you think. So you need to be careful if you're near any of those thresholds. There's no double dipping with PPP. We've talked about there's no double dipping with some other federal funds. There's no double dipping with sick leave credits. The owners and the families of owners, I should say majority owners, are disallowed. There are different PPP rules that apply to the owners, but they don't get ERC. We need to be including health insurance costs and sort of how does that work. Allocating the PPP, there's incredible flexibility within that. And then we have some nuances as to whether or not we're looking at cash or accrual-based wages. ERC, on the other hand, is cash basis wages. So we're trying to manage all of these sort of other rules, in addition to all of the gross receipts nuances, the partial restrictions nuances. So this is what's causing all of the complexity. This is why it is so much work to figure it out. But at the same time, this is why it's very rewarding when you do manage to get it. So now let's talk about some specific examples. These are studies we've done. So to get an idea, we have done over 300 studies, and our clients have claimed almost $100 million of credits. We're coming pretty close to 100 million. We'll probably get there in another couple weeks, which is crazy to think about. But it's amazing we've helped so many, and here's to the next 100 million, hopefully. So a few examples of some unique situations that I thought were worth sort of calling out and explaining. So this is a manufacturing business and a hair salon. They are operated and owned by the same person. They have the same management. They're sort of co-managed. That created a group. The salon was going to qualify for ERC. The salon is obviously restricted. The manufacturing business, they were unlikely to qualify. Almost certainly they were not going to. But by grouping them together, we got an extreme result, which is like $500,000 of ERC for the manufacturing business. Manufacturing business was going to get zero. But by grouping them together, they got $500,000, which is amazing. But that's one example of these grouping rules creating extreme results. Another one was a group, they've got some holding company, they got real estate, some media stuff, but it's owned and operated by one family. Their activities in a number of states. There was a lot at play in this study, but they ended up qualifying based on gross receipts. And, the key to this study, they ended up getting like $5 million. The key to the study was understanding the grouping rules and also the gross receipts rules. So it was a combination of these things which impacted and created the ERC for the client, where you would ordinarily look at it and say, was any of these businesses shut down? No. Does it seem like they should qualify based on gross receipts just by looking at, any of these businesses? No, not really. But if you look at it in total and you do the grouping analysis and you do all this with the gross receipts, they ended up getting, $5 million that otherwise they probably would not have received any. Example of a salon with, a bunch of employees in a blue state. Sometimes the blue state versus the red state matters a lot because of the restrictions. So that's why a few of these are going to mention. But we'll see it's not entirely about, the restrictions in your state. So in this example, it's a salon. They qualify based on restrictions into May 2021. That's the influence of the blue state right there. So they had capacity restrictions. But then they also qualified based on gross receipts in second quarter, which meant they ended up getting all of second quarter and then all of third quarter. So that's a very useful result. So why is this one even on the sheet? Because they have 170 total employees, but they still qualified for ERC in 2020 because we really understood the FTE rules. The FTE count for this business was less than 100. They have 100 in total, 70 total people, and it ended up being less than 100 FTE counts. So that was critical. Another critical factor is some of those nuances with the gross receipts, which is how they qualified in second quarter 2021. And so between those two important but sort of esoteric nuances, they ended up getting about an extra $1 million of ERC. In total, they got about 2.5 million, which is a tremendous, tremendous result. Here we'll see a restaurant. So a restaurant in a blue state, like Minnesota, this is where we see sort of a pretty standard approach. But with the restaurants, they've got RRF. It's sort of like PPP2 or PPP3, I called it for a while. Nick knows all about the RRF funds, but you can't double dip on those. So, just based on the partial restrictions, they got about a 14, 15 month window there, end up qualifying for 600,000, roughly 200% of their PPP loan amount. So I throw that in there just for scale. Like, PPP was huge. PPP saved the restaurant. The 300,000 saved them. The PPP2, kept them in business while they're still dealing with restrictions. And then the ERC is really going to help supercharge that business. So an example of a salon that was in a red state. So they did not have the same kind of restrictions. They only had restrictions into September 2020. So their ERC is much less. You can see that it's only, about 50%. But here, it was a tremendous example of how using 24 weeks and including non-payroll costs really helped them with their ERC situation. In the end, they ended up getting about 60,000 more ERC because they included the non-payroll cost. They took a little bit of extra time and, knock on wood, they listened to my advice and they included non-payroll cost. So it's an example of how big of a difference just how you fill out those PPP forgiveness applications, how big of a difference it can make in the outcome. Like 30% of their ERC was because of the non-payroll costs they included. Had they not included them, they would have been looking at 60 grand less. Another salon in red state. So just because it's a red state doesn't mean they didn't have restrictions. Some more than others, but this red state, they did have restrictions into May. So it is possible. You don't want to just write it off thinking, oh, I'm in Texas or I'm in, Florida or some red state. Some are different than others, and they qualify broadly based on the partial restrictions, but then again, they managed to get those gross receipts, which qualified them for another basically quarter and a half, which added on top. So they, again, they got a huge amount, 200% of their PPP amount, even though they were in a red state, which doesn't, scream out, I have a lot of COVID restrictions. So here's an example of another study we did. They were a sort of construction engineering contractor business, and they were in a few different states. They got good amounts of PPP money. We ended up qualifying them for nearly $1 million of ERC. The secret sauce on this one is changing the accounting method. So any type of a business like a contractor, or any type of business with a lot of payables or large receivables that might come in all at once is a great opportunity to look at the gross receipts test and see if changing your accounting method can trigger the decline in gross receipts. Because on a cash basis, accrual, the whole idea of accrual is you're recording everything as you go and it sort of smooths it out. Cash basis, you can have these big swings where at the end of a quarter, you happen to have a lot of accounts receivable outstanding. And then, the first week of the next quarter, a client paid you a big client paid you. And that could trigger sort of just this fluctuation in gross receipts that you need to qualify for ERC. So in this situation, we looked at it initially and they qualified for nothing. They did a change of accounting method, which triggered this gross receipts decline, and they ended up getting almost $1 million. So that's where you really need to understand all of the nuances and all of the things available with gross receipts, because it's not always obvious. It's not always going to hit you right in the face. We want to look beneath the surface. So I got a couple of slides here just on sort of our process and our procedures. We determine the qualifying period, and then we're looking at doing these calculations. So we're looking at employee by employee, quarter by quarter. You can't double dip. You can't double dip with sick leave credits, PPP forgiveness, but you can be picking and choosing. That's how the calculations go. After we've calculated all this, then what happens? Well, then you file an amended payroll tax return. For the effective quarters, you mail it to the IRS and you get a check. Big question is, when are you going to get that check for each quarter? Typically, we're seeing like 6 to 9 months later. It's possible that timeline, gets a little better as the IRS gets caught up. I also think it's very possible the timeline gets worse because there's a huge backlog of these. And from what we've seen, the IRS, the recent checks that we've seen have been people that filed in August 2021. That's my experience. And also the money is taxable. So you need to amend the income tax returns because 2020 ERC is taxable in 2020. 2021 ERC is taxable in 2021. Even though maybe you have not filed your 21 returns yet, that's a whole discussion of, do you want to include it on your original or do you want to go back and amend it later? Lots of options there. So a little more detail on, B&B, how are we doing this? These are the steps. We call it intake. So that's, I've talked about Tiffany and Nick. So that's me, Tiffany, and Nick. We qualify the business. So that's going to be either the total shutdown, the partial restriction, the gross receipts. So we're going to work with the business owner or, the controllers or CFOs at those businesses, and we're going to work through the intake process. Then once we've determined that timeline, then we have a team of people. It's quite a team of amazing folks that help us do the calculations. So that's where we get all the payroll data. That's where we get all the PPP stuff. And we do the calculations. We have an enormous spreadsheet to help us do this. We verify those calculations. Then, as we talked about, after we do all this, then you prepare the 941X. So the amended payroll tax returns. So we have somebody who prepares those, somebody who reviews those, and then, assembly and finalize. That's where either me, Tiffany, or Nick, we get back in there, take a last look at it, any final touches that are needed, and we will deliver the results to the client and send the invoice. So this is not a free service, and people always would like to know how much it costs. So we do have a slide on the pricing. It's a little complicated, but pricing is basically per employee that qualifies, and the fee is capped at 10%. If there's no PPP, then we charge less because it's less work. The fee is still capped at 10%, but you probably won't get there. So $300 per employee or $150 per employee, and they're going to be capped at 10%. And if we get a better idea of what your business is, we can, sometimes even estimate the fee for you a little bit better. So I wanted to talk about some common misconceptions because we've done over 300 of these studies. I've probably talked to hundreds and hundreds of people about this, and I hear some of the same misconceptions that are being spread wildly. So I want to address a bunch of those here because I think it'll really drive home sort of how the process works and how ERC works. I used my money on PPP wages, so I cannot claim ERC. This is false. There's no double dipping allowed, but there's incredible flexibility in how you pick and choose when you spent that money on PPP wages. How you filled out the forgiveness application is definitely going to play a big role. But just because you got a PPP loan and just because you said you spent it all on wages, that does not mean you cannot also still claim ERC. I cannot get ERC in 2021 because I got a PPP 2. Again, this is false. You cannot double dip, but you can still have both if you qualify for ERC. This flexibility, the picking and choosing, is tremendously valuable. It's complicated because there's a million possible outcomes, but if there's a million possible outcomes, then we can choose the one that results in the most ERC for you. So complexity, is pretty annoying, and it's why these projects take so much time and effort. But complexity can also yield the most favorable result for you. So again, how you fill out that forgiveness is going to play a big role in determining how much ERC you get. I cannot qualify because my revenue was flat. This is false. There are 3 different tests. You don't have to meet them all. You can meet either of them. If you had partial restrictions, it does not matter how high or low your gross receipts are. Some businesses got back to even though they were dealing with restrictions. Kudos to you if that's your situation, that's great, but it doesn't mean that you don't qualify for ERC. I can't qualify for ERC because my revenue was up. So we've seen a number of these where they're like, revenue was up, I don't qualify. Well, a lot of businesses, they were growing beforehand, and the restrictions limited their growth tremendously, but they still grew because they were adding locations, they were adding staffing, whatever. If you qualify based on gross receipts or the partial restrictions, then it doesn't matter about your gross receipts. So it is possible to get ERC. My payroll company can calculate it for me. Sorry to any of the payroll companies listening to this, but we've seen their work. It's very poor work. They have no idea what they're doing. Because what the payroll company is doing is asking you, how much do you qualify for? They're not really doing the legwork. What they're doing is the amended 941s, which is the easiest part of the whole thing. Recently, payroll companies have started to up their game, and they say they're going to look at it more holistically, but they don't have a bunch of CPAs on staff. They are not PPP loan experts. They are not gross receipts experts. I think if you use a payroll company, you're pretty likely to get the wrong result. You might get too much or you might get too little, but we've seen a bunch of people use payroll companies, and I've never seen one that got the right answer. So I would probably not have your payroll company do this for you. A friend of mine got way more or way less, so mine must be wrong. So this is the most complicated thing we've ever seen. There's a lot of factors. Any of these factors can have a big difference in the outcome. So it's very hard to compare what your friend's business got because the details matter a ton. So don't, if your friend looked into it and said they don't qualify, That doesn't mean that you don't. You want to take a fresh look at it. There's just a lot of factors at play. A bunch we haven't even discussed, like how many of the employees are related to the owners? How do you have a partnership, or do you have an S corp? Because wages for S corp owners count, guaranteed payments for partners don't. There's just a wide range of factors. So it's going to be different for everybody. I need to file this before the end of the year. I mean, you can tell I put this together in December when I was doing these. You have 3 years to do ERC. You have 3 years to amend the quarter 941. So you have time. The sooner you get to it, the sooner you will get in line to get your refund processed. So, I do think you want to start looking at it now. You can be doing them this summer. That's totally fine. You have 3 years. And the money does not run out. It's not like PPP. If you file it in June, the money is not going to run out. That's not how it works. It's not like PPP in that respect. I've talked to a bunch of people who are like, oh yeah, my payroll company did it. I already filed this for 2020. I can't do it again. That's false. You can always amend your amended 941. If it turns out they made a mistake and you either claim too much or not enough, you can still fix it. You've got 3 years to fix it. Don't look at it and say, oh yeah, my payroll company did it a little fourth quarter and I got a little bit of money. Take a fresh look at it. Take a serious look at it. And if it was wrong, you can correct it. Not a problem. I don't need the money right now, so I don't qualify. This is a very common one. This is false. No part of the 3 ways you qualify for ERC requires that you demonstrate a need for the money. PPP, you had to certify that you needed the money. PPP, you had to certify there was uncertainty and this money was going to help keep you in business. There's nothing like that for ERC. It's like a child tax credit. That's how I like to explain it. If you get to the end of the year and you have children and your income qualifies you, then you get the child tax credit. Nobody ever says, do you need the child tax credit? They ask if you qualify and then you claim it. So that's how ERC works. ERC is wildly complicated to figure out if you qualify. But once you do, it really has nothing to do with whether or not you need it. And if you claim it, that doesn't mean that somebody else won't get it. So you don't need to be too worried about that part. It's problem enough to figure out if you qualify. So I think that's what you want to do, is figure out if you qualify for it. And if you do, I would proceed and claim it. So I think I'll maybe just skip over these in the interest of time, but there's some very strange things happening with cash lately. We got ERC all over the place. ERC is taxable. You got your PPP loans. I've laid out a few steps to sort of look at ERC and then get back to normal. Try and figure out what normal looks like going forward and, spend down that cash and get back to a normal plan, hopefully in 2022. Certainly we'll be here to provide lots of advice, probably more webinars, but just a few closing thoughts before we get to the Q&A. If you have not done it yet, you want to submit your PPP2 forgiveness and use 24 weeks payroll, 24 weeks non-payroll cost. You want to calculate the ERC and take a look at it based in 2020 and 2021, based on both the partial restrictions and the gross receipts test. It is the craziest thing I have ever seen. I am quite confident it is the craziest thing that is ever going to happen in my career. Don't miss out on exploring it. As I said, we've done in excess of 300 projects, and we are almost at 100 million of credits for clients. And we would love to help you with this. And then, after you've done ERC or you've looked at it, sort of try and reset, figure out the cash situation, plan for a more normal 2022, both, as it relates to owner compensation distributions. What do you actually do with the ERC money once you get it, like 6 to 9 months later after you submit it? So those are the things, those are the 3 big takeaways I would be looking at. Certainly, we can assist you with any and all of this, either the PPP, if you still need any help with that, or the ERC calculations. As I said at the top, ERC@myboyum.com is the email that we are using. And when I say we, I mean the 3 of us. So there is Tiffany and Nick and myself. I focus on the salon industry and sort of lead the team, nominally the leader. Tiffany certainly is the leader on the nonprofits, but works on quite a variety of industries. And Nick is the leader on restaurants and breweries and sort of the hospitality industry. So, partially that's how we will decipher out or assign out the ERC projects. So shoot us an email at the ERC, and we'd love to assist you. So I think I will stop talking after 57 minutes and see if there are any questions. And let's look at the chat and just see if anybody's got some questions for us.
We were able to answer the questions as they were coming up. There were a few pretty specific ones that Tiffany nicely replied to. Some of her replies went to all. That might have been helpful on a few of them, or if they were confusing, we can explain later. But yeah, if anybody has a question, let us know. We can sure answer it in the 2 minutes we have left.
Yeah, so just looking at some of the questions. Oh, I see. There's Tiffany's reply. Yes, lovely. So the 21 rules, they're a little bit different. $7,000 per quarter, but you got to qualify for all those quarters. And then you're probably looking at 3 quarters. It's only these startup businesses that get it in the 3rd and 4th quarter. And it is possible to get regular ERC and the startup ERC for the same business. So in theory, that's possible. But there are definitely some other rules on those startups. So yes, all the nonprofit questions Tiffany has answered. That's good. All right. So if there are not any other questions, I think we will wrap it up. But we would love to assist you, even if you don't think you qualify. If you have employees and you paid them wages and COVID impacted your business, I think it's worth looking at. And I think that's almost everybody. So certainly reach out, ERC@myboyum.com. We'd love to assist you. And, stay tuned. I'm sure we'll have more webinars to come probably this summer. So bye, everybody.